When you opened your inbox today, you probably expected the usual noise. Discounts, promotions, maybe a newsletter you forgot you even signed up for. But instead, a lot of people saw something far more disturbing. Not an offer to sell them silver, but a plea to buy it from them. And if that didn't immediately raise the hair on the back of your neck, it should have. Because this wasn't a typo, it wasn't clever marketing. It was a distress signal. If you've purchased physical silver from a major bullion dealer anytime in the last few years, there's a good chance you received an email that said, very plainly, "We want to buy your silver. Not tomorrow. Not when prices come down, now, immediately, and not at spot price at a massive premium. Let's slow that down because this is where the story stops being normal." The paper spot price, scrolling across Bloomberg and CNBC, is sitting right around $99 per ounce. Calm, controlled, almost boring. But behind the scenes, dealers are offering $125, $128, sometimes even more for generic silver rounds. Cash, immediate wire, no hassle. That's a $25 to $30 premium on the buy side. That is not how markets work. In a healthy precious metals market, you pay the premium. The dealer buys near spot, sells to you at spot plus $4, $5, $6. That spread is their business. That's how it's always been. But what we're witnessing right now is a full inversion of that model. The dealer is now paying you the premium because they cannot source inventory through normal channels. And when the people whose entire job is to move physical metal can't get metal, something is very wrong. What's happening is simple but deeply uncomfortable. The retail investor, people like you, has quietly become the supply chain. Your stack is now the inventory. You are the mint. And if you don't understand what that signal means, you're going to misprice one of the most important assets you own. Before I go further, let me be blunt for a moment. This kind of information does not travel well in algorithm-driven platforms. It never has. My last deep dive on comics delivery risk should have reached 500,000 people. It barely broke 50,000. So if you're hearing this, engage with it now, not later. Every interaction forces this conversation into places it's actively being kept out of. Now let's talk about evidence, not opinions. I've been sent screenshots from across the country, emails from AppMax, JM Bullion, SD Bullion, and regional dealers you've never heard of. Different brands, same message. Sell us your silver. When customers click through to get a quote, they're not seeing spot minus $2 like they would have a year ago. They're seeing spot plus 20, spot plus 25. In some cases, spot plus nearly 30. Ask yourself a simple question. Does that sound like a market with plenty of supply? Of course it doesn't. It sounds like a market where the physical and paper prices are violently disconnecting, and the people closest to the metal know it. That's why they're scrambling. That's why they're emailing you instead of the mint. Here's the mechanism, and this part matters. In normal conditions, a bullion dealer restocks through established relationships. U.S. Mint, Royal Canadian Mint, Perth Mint, private refiners. Orders go out, metal comes in, spreads stay predictable. But since late 2024 and accelerating hard into early 2025, those channels have started to fail. Delivery times for Silver Eagles are now quoted at 8 to 12 weeks. The Royal Canadian Mint has suspended new orders altogether. Perth Mint is rationing dealers to a few hundred ounces per week. These are not rumors. These are operational facts. So what happens when a serious buyer calls? Picture a family office managing billions, or a tech founder quietly converting liquidity into hard assets. They don't want 10 ounces. They want 100,000. And they want it now. Wire transfer ready? The dealer looks in the vault, and there's nothing there. At that moment, the dealer has two choices. Tell the client to wait 3 months and probably lose them forever, or go hunting for metal anywhere it exists. Even if that means paying retail holders a premium they've never paid before, they choose option 2. Let's run the math, because numbers don't lie. 100,000 ounces at $99 spot is a $9.9 million order. If the dealer offers spot, no one sells. Most people bought silver at $25, $30, maybe $40. They didn't hold through volatility just to hand it back at the first triple-digit print. So the dealer raises the bid, 120, 125. Suddenly, sellers appear. Now the dealer's cost basis is $12.5 million. They turn around and sell to the whale at $130. That's a $500,000 gross margin on a $13 million transaction, about 4%. In normal times, that margin would be laughable, but these aren't normal times. This isn't about profit maximization. It's about survival and client retention. Lose a $10 million client once, and you may never get them back. Here's where it gets interesting. What if people stop selling? What if enough holders look at a $125 buyback offer and realize it's actually AI signal? If a dealer is paying that much, it means they believe the clearing price is far higher. And once that realization spreads, the feedback loop turns vicious. Higher bids signal future scarcity. Scarcity reduces willingness to sell. Reduced selling forces bids even higher. Eventually, something snaps, Either the paper price explodes upward to meet reality, or the paper market simply breaks and settles in cash. That's the end game everyone pretends isn't possible, until it is. This is why street-level data matters more than official reports right now. Call your local dealer. Ask what they're paying on buybacks. Don't posture. Don't announce a sale, just ask. Then compare notes. The truth isn't on a screen, it's in the spreads. Zoom out, and this stops being just a silver story. This is a hard asset repricing driven by the slow-motion collapse of confidence in fiat currency. We are 50-plus years into an experiment that began when the gold window closed in 1971. Since then, the money supply has expanded more than 30-fold. Silver production barely doubled. That imbalance doesn't resolve politely. For every ounce of physical silver, there are multiple paper claims floating around exchanges like the COMEX. In quiet markets, that leverage doesn't matter because most traders cash settle. But what happens when delivery demand spikes? 10%? 20%? The math stops working. The metal isn't there. And when exchanges can't deliver, they don't admit failure. They change the rules. Cash settlement, force majeure. Take the check and move on. We've seen this movie before. In 2008, paper silver collapsed from $20 to $9. Headlines mocked it as a failed safe haven. Meanwhile, try buying a silver eagle for less than $25. You couldn't. Dealers were empty. The U.S. Mint halted production. The spread told the real story. By 2011, silver was pushing $50. The people who ignored the paper price and watched the physical market didn't panic. They positioned. Right now, the physical market is screaming again. Dealers bidding aggressively. Mints rationing. Whale orders draining inventory. This isn't noise, it's a signal. And signals like this don't last long. What we're watching right now isn't new, it's familiar. And if you lived through 2008 with your eyes open, you already recognize the shape of what's forming. Back then, the disconnect between paper and physical didn't close gently, it snapped. And when it snapped, it did so violently. The same divergence is back on the table, and the only real question is timing, not direction. The paper price will catch up to the physical price. It always does. The only variables are whether it takes 3 months or 6, and how chaotic the move is when it finally happens. The math behind it hasn't changed, and markets don't get to vote against math. They only delay it. Now zoom out for a moment, because this isn't just an American problem or a COMEX problem. This is global. And there's one major player whose fingerprints are all over this situation, even though mainstream financial media seems determined to look the other way. That player is China. According to data from the Shanghai Gold Exchange, China imported roughly 200 metric tons of silver in December 2024 alone. That's about 38.5 million ounces in a single month. Let that number sink in. Global mine production is roughly 820 million ounces per year, or about 68 million ounces per month. China absorbed more than half of 1 month's global supply in December. That silver didn't materialize out of thin air. It came from London vaults, from Swiss refineries, from metal that, under normal circumstances, would have been feeding Western mints and bullion dealers. Instead, it's being loaded onto ships and sent east. Why? Because that's where the highest bidder is. When you convert the Shanghai silver price into dollars, it's trading several dollars higher than COMEX. That spread creates a clean arbitrage. Refineries aren't sentimental. They ship metal where they get paid the most. And right now, China is writing the biggest checks. That leaves Western dealers empty-handed, which explains why your inbox suddenly looks like a desperate Craigslist ad instead of a sales pitch. They're not emailing you because they're feeling generous. They were emailing you because they can compete with a buyer that has effectively unlimited currency and a strategic reason to deploy it. China understands exactly what it's doing. The People's Bank of China has been accumulating gold month after month for over a year. Official reserves are now around 2,300 metric tons. And unofficial holdings, through state-owned enterprises and sovereign vehicles, are likely several times higher. And now they're doing the same thing with silver, quietly, aggressively, relentlessly. History offers a simple rule here. When China is hoarding hard assets, you don't rush to sell yours. You let them do the heavy lifting. Because when a buyer of that size steps into a relatively small market, the outcome is never subtle. Let S bring this back home and look at the scale of what West's sitting in retail hands. Conservatively, there are perhaps 20 major bullion dealers in the US, each with customer lists in the tens of thousands. Even after accounting for overlap, you're probably looking at around 500,000 unique retail holders. If the average stack is 300 ounces, and that's not an aggressive assumption, that S roughly 150 million ounces sitting outside the institutional system. Now imagine just 10% of those holders decide to sell in response to buyback emails. That's 15 million ounces. At $125 per ounce, dealers would need to pay out nearly $1.9 billion to acquire that metal. They don't have that cash sitting around. It's being wired to them by whales in advance, family offices, funds, private capital saying, here's the money, go find the silver, I don't care how. The demand is real, the capital is real. The only wild card is whether retail holders blink. And that brings us to the core question everyone is quietly asking. Should you sell? My answer is straightforward. Not at 125, not at 150, not unless you facing a genuine personal emergency and need liquidity, because no dealer pays above spot out of kindness. They do it because they believe the metal will clear much higher. If they expect to flip it at $150 or $175, that implies a real market price north of that. Selling at $125 just transfers that upside from you to the middleman. If you've waited years to own this metal, don't rush to hand it over just because the phone finally rang. Now, let's connect this to the broader liquidity picture, because silver doesn't move in isolation. The Federal Reserve's reverse repo facility tells a quiet but powerful story. As of January 2025, balances are down to around $180 billion. A year earlier, they were over $2.2 trillion. That's a $2 trillion drain in 12 months. That money didn't disappear. It flowed back into the system, into equities, into bonds, into crypto, and increasingly into hard assets. When reverse repo drains, liquidity looks for protection. And with the Fed already cutting rates and openly discussing further easing, smart money isn't waiting for the official announcement of the next QE program. They're positioning ahead of it. Hard assets rally when monetary discipline fades. That's not ideology, it's pattern recognition. This is why physical premiums are exploding while paper prices look sleepy. The paper market is backward-looking. The physical market is forward-looking. And right now, the physical market is shouting. There's also a very practical reason this information matters. Without it, you're vulnerable. Walk into a coin shop uninformed, get offered $95 or $100 per ounce, and you might think that's reasonable. It's close to spot, after all. But now you know better. In some markets, that same ounce is clearing at $125 or more. On a 500-ounce stack, that's a $15,000 difference. That's not theory, that's money. Now let's talk about how this typically unfolds, because markets move in phases. The first phase is where we are now. Quiet accumulation, dealer emails, rising premiums, no headlines, no panic. Official narratives still insist everything is fine. Phase 2 is when something breaks publicly. A major dealer suspends sales, a mint announces rationing, an ETF pauses redemptions. Once that happens, the story flips overnight. Retail FOMO kicks in. People who've never owned an ounce suddenly want 50. That's when prices don't move, they gap. We've seen this movie. In 2010 and 2011, silver went from boring to irresistible in months. The move wasn't linear, and it wasn't polite. Phase 3 is the endgame. That's when paper claims are exposed for what they are, and delivery failures become impossible to spin. Cash settlement replaces metal, lawsuits follow, investigations drag on, and during all of that noise, the physical price does whatever it wants because it's no longer tethered to a broken benchmark. At that point, you're not selling silver for dollars. You're trading silver for assets, property, businesses, real things, because the currency has lost enough credibility that metal becomes the reference point. So when someone asks whether $125 is a good exit, the real question is this. Do you want to sell insurance while the storm is still offshore? The whales already made their choice. They're not buying at $150 to make a quick flip. They're buying because their models point much higher. These are not reckless actors. They have access to information, relationships, and data most people never see. When they move in size, it's worth paying attention. As for me, I'm not selling at these levels. Not even close. Maybe I trim a small portion when we see $200. Maybe. But the bulk stays put. Because this isn't a trade, it's protection. And you don't cancel your insurance policy just because the wind hasn't hit yet. We're not at the climax of this story. We're still in the opening act. And the early signals, the emails, the premiums, the quiet accumulation, are already telling us how the ending usually goes. I'm careful about what I say publicly when it comes to exact moves, not because I'm trying to be mysterious, but because markets listen. I don't like broadcasting my playbook to algorithms or to people who trade against sentiment for a living. That said, I do share those details privately with members. If you choose to join, you get access to posts where I lay out my real plan, actual price levels, percentages, and decision points. Not hype, not vibes, but numbers. For example, I might explain that at $200, I am trimming a small portion just to pull my original capital off the table. At $300, maybe another slice to lock in gains. At much higher levels, larger trims. And a meaningful portion I don't plan to sell at all because that part isn't an investment, it's insurance. Members also get early access to videos, private live streams, where we go through data in real time, and a community that doesn't panic at the first red candle. It's $5 a month, which, at this point, is less than the premium on a single silver round. If that kind of clarity matters to you, you know where the button is. Now, let's step back and add some historical perspective, because none of this is unprecedented. In 1979, the Hunt brothers became the villains of the silver story. The simplified version everyone hears is that they tried to corner the market, got greedy, and deserved what happened next. The reality is more nuanced. They saw inflation running hot, they saw the dollar losing purchasing power, and they wanted to preserve wealth using hard assets. Silver was their vehicle. The price ran from roughly $6 an ounce to nearly $50 in about a year. The establishment panicked. Rules were changed mid-game, long positions were restricted, liquidation was forced, prices collapsed, the hunts were wiped out. But here's the part that gets conveniently left out. If someone had bought physical silver at $6 in 1979 and simply held it, no leverage, no futures, no margin, they would have still seen extraordinary long-term gains. Even after the crash, silver eventually returned to those highs decades later. The hunts didn't fail because silver was a bad idea. They failed because they used leverage in a system where the rule makers can rewrite the rules. That lesson matters today. Physical metal in your possession doesn't get margin called. It doesn't care about contract specs or exchange rule changes. It just sits there, patiently waiting for reality to catch up. And the setup today, frankly, is more extreme than it was back then. In 1979, inflation was high, but sovereign balance sheets were relatively clean. Today, we're dealing with massive debt loads, fragile banking systems, commercial real estate stress, geopolitical fractures, and a monetary system that runs on confidence alone. That combination doesn't shrink the upside for hard assets. It expands it. Silver hit roughly $50 in 1980. It hit roughly $50 again in 2011. The next major peak doesn't have to stop there. Maybe it's 100, maybe it's 200, maybe it's higher. No one can give you a precise number, but we can evaluate probabilities. And the probabilities right now favor higher prices, not lower. Another piece people underestimate is mining supply. Global silver production in 2024 was around 820 million ounces, down from the year before. That's not a blip, it's a trend. The high-grade, easy-to-access deposits are largely gone. What remains is lower-grade ore that costs more to extract, requires more energy, and generates thinner margins. At current prices, many mines are barely profitable. All-in sustaining costs hover uncomfortably close to the market price. That doesn't incentivize aggressive expansion or new projects. It encourages caution. Meanwhile, demand isn't standing still. Industrial usage keeps rising. Solar, electric vehicles, electronics, infrastructure. Jewelry demand is steady. Investment demand is accelerating. So you have tightening supply meeting growing demand. Markets don't need a PhD to figure out how that usually resolves. This is why large buyers aren't waiting for confirmation on CNBC. They're not sitting around hoping silver breaks a psychological level before acting. They're buying when it's uncomfortable, when the paper price looks calm but the physical market is strained. They understand that once the move becomes obvious, it's often too late to build size without moving the market against yourself. To be fair, there is a bearish case, and it deserves to be acknowledged. The bearish argument says this is a temporary dislocation. Holiday demand, shipping delays, mint bottlenecks. Give it a few months, production catches up, premiums fall, buyback emails stop, and everything returns to normal. That scenario isn't impossible. Markets do overshoot in both directions. But the problem with that argument is that these issues aren't new. Mints have been struggling to keep up for more than a year. Record sales haven't translated into smooth supply. Rationing didn't start last week. Capacity constraints didn't appear overnight. Fixing them would require major capital investment, long lead times, and confidence that demand will persist. None of those boxes are checked. As long as those bottlenecks remain, physical premiums remain elevated. As long as premiums remain elevated, dealers have to compete for inventory. And as long as they have to compete, buyback prices stay aggressive. That's not emotion, that's mechanics. If you want to monitor whether the situation is real or just noise, there are a few practical indicators worth watching. Look at weekly U.S. mint sales. Sustained high numbers signal real demand. Watch COMEX registered inventory, not total inventory. Registered metal is what's actually available for delivery. Persistent declines there matter. Pay attention to retail premiums. If they stay elevated for weeks, not days, that's confirmation. And keep an eye on international price spreads, especially Asia versus the West. When those gaps widen, metal moves. Some people will accuse anyone talking about silver right now of pumping. That's predictable. I'm transparent about owning silver. I'm also transparent about owning other assets. This isn't about cheerleading. It's about presenting evidence. Dealer behavior, mint data, inventory trends, and international flows aren't opinions. They're observable facts. If those facts change, the thesis changes. Simple as that. Let's run one more straightforward example. Waiting doesn't require genius. It requires patience. You don't need perfect timing. You just need to avoid selling into a shortage before the price reflects it. And that's really the core message here. Don't confuse a good offer with the right offer. Dealers aren't charities. They're intermediaries responding to pressure from bigger players. When they bid aggressively, it's not generosity, it's necessity. If you genuinely need cash for a real-life emergency, that's different. Markets don't override personal realities. But if you're selling simply because the number looks tempting, understand who's on the other side of that trade and why they're there. The smartest money in the room isn't trying to flip silver for a quick gain. They're positioning for a shift in how value is measured. You don't want to be their exit liquidity. Hold your metal. Let the story play out. And when the price finally reflects the strain we're already seeing behind the scenes, then you decide how much to sell, if any. Until then, patience isn't passive. It's strategic. We're not at the end of this move. We're closer to the beginning than most people realize. And if history is any guide, the hardest part isn't buying. It's not selling too early.